Hi, it's Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's late afternoon, Wednesday, February 11, 2015, and the title of today's audio blog is A Tale of Two Commodity Markets. Well, it's just after the market close on Wednesday, and the supposedly all-important emergency Eurogroup meeting is still going on into Europe's wee evening hours, with not a peep as of yet. Not that there's much to say at this point, as it was the Eurogroup itself that last Friday moronically accelerated the Grexit deadline date from February 28th to February 16th, i.e. Monday, by issuing a hostile ultimatum for Greece to accept a bailout extension by then or Grexit the euro currency. This weekend, Greece's Alexis Tsipras made it crystal clear that no bailout extension would be accepted, and thus why everyone is not investing accordingly is beyond me. Other than, of course, that last month's maniacal ECB QE announcement signaled that whatever it takes Draghi, Whirlybird Janet, hyperinflation Shinzo, and other central bankers will literally monetize every stock and bond on the planet if necessary, which can't possibly have negative ramifications. Not to mention that several banks, like Japan's, actually admit they are purchasing stocks to maintain confidence in paper assets. Actually, as I write at 5 p.m. Eastern Standard Time, not 15 minutes after starting, headlines of a Greek agreement in principle just hit the tape, which, if true, would mean that it took Alexis Tsipras less than 2 weeks to forsake everything he promised the Greek people by taking additional bailout money and allowing the very bureaucrats who reduced his nation to economic rubble to destroy whatever equity still remains in its assets, whatever pride remains in its people, and whatever hope remained on the planet for fiscal and or monetary prudence. Not to mention, he would have lied about what he had just said on Saturday. I'll get back to that later on, as frankly, until I see details, I don't believe a word I hear from sociopaths that will stop at nothing to prevent a collapse of global confidence, most commonly via egregious propaganda and blatant market manipulation. Anyhow, while still on the topic of money printing, I want to share a question posed to me by a reader this afternoon. He didn't understand why printing money is such a bad idea, given that it doesn't inherently increase debt and supports financial markets. I did my best to respond calmly, and here's what I wrote. Quote, the act of printing money doesn't create debt, unless, of course, it is used to purchase sovereign bonds that would not have been issued otherwise, as no one would have bought them. Mostly, they just create asset inflation and leverage up central bank balance sheets with toxic overvalued assets that taxpayers will eventually have to bail out when they crash. And by bail out, I mean the central bank is forced to print still more money, stoking inflationary pressures further, particularly for need versus want items. That said, if banks actually lent out the printed money handed them, societal debt levels would rise. However, banks are insolvent already, so they either hoard the essentially free funds utilizing carry trade investments to book essentially riskless profits, or alternatively gamble them on PPT and Fed-supported markets, creating massive societal wealth disparity and historically overvalued markets, with not a semblance of correlation to economic reality, which only fuels further malinvestment, of which the resulting overcapacity is responsible for massive market dislocations, such as the historic currency and commodity plunge we are witnessing today. Not to mention, each additional currency unit printed devalues all those before it, taking us one step closer to the inevitable loss of confidence in its value and eventual collapse that all previous fiat currency regimes have undergone. In other words, the fiat Ponzi scheme is growing exponentially larger to the benefit of a handful of less than 1%ers and the detriment of all others, both here in the States and worldwide. It's gotten to the point that there is no longer doubt that all sovereign debt is too big to repay, and with each passing day, such debt is expanding dramatically, more rapidly. Let alone in a worldwide economy, which as I have for months now claimed is at its singularly weakest point in our lifetimes, and care of the aforementioned historic overcapacity created by decades of central bank fueled malinvestment will unquestionably weaken dramatically further before even a hope of supply-demand balance is possible. Note today's all-time low in the Baltic Dry Index and WTI oil prices plunging back to $49 per barrel, following this morning's announcement of the highest U.S. crude oil inventories in 80 years, if you think otherwise. Heck, even Goldman Sachs joined Citigroup in pounding the table for $20 to $30 oil today, as the entire junk bond-laden shale sector desperately high-grades production to milk as much revenue as possible to prevent imminent bankruptcy. Which, by the way, is no different for low-cost Middle East producers like Saudi Arabia, who not only will never allow high-cost producers to take their market share, but are equally desperate for revenues given the massive budgets their irresponsible socialist governments have implemented. Not to change topics again, but for crying out loud, just 15 minutes after the Greek debt deal agreement in principle headlines hit the tape, a factual statement that no agreement is in place replaced it, replete with commentary that a Greek government official says no agreement, Greece will not accept an extension of current bailout. In other words, just like yesterday's fraudulent rumor of a 6-month debt extension being offered, the powers that be are out in full force with their lies today. We'll see what ultimately happens, as eventually reality will usurp propaganda. And based on what Tsipras has said all week, it's hard to believe it ends happily for the force's dark side. That said, I have much to get through today. Yet sadly, of all the world-threatening horrible headlines besieging us, the one that struck me as most symbolic of how far civilization is falling is news that the feel-good story of the inner-city Chicago kids that nearly won the Little League World Series last year was as much of a sham as essentially everything else in America these days. I mean, we all know that baseball parents can be ruthlessly unsportsmanlike as anyone, but in covertly redrawing district boundaries to recruit ringers from neighboring towns, they took cheating to a level typically reserved for the aforementioned bankers and politicians. And to think this organization was named Jackie Robinson West, saluting one of America's bravest, most courageous citizens. Anyhow, I could just as easily have called today's podcast Lies the Word, as wherever one looks these days, said bankers and politicians are vaporizing not only the truth, and whatever credibility they still had, but destroying countless millions, and in some aspect billions of lives in the process. To wit, Obama's formal request to Congress today, which frankly I'm shocked it didn't come in the form of an executive order, for unlimited war powers against the amorphous ISIS movement in any country he desires. Yes, the president elected on a platform of staying out of the Middle East, who took years of waffling to actually do so, is back with a vengeance, ready, willing, and able to put American boots on the ground against a so-called enemy that poses less threat to America than Al-Qaeda ever did. Well, I guess that means more government defense spending, damn the deficits. But don't worry, bombs funded by printed money will be included in GDP, so the U.S. economy will grow as a result. And speaking of wars, what about the real war going on in the Ukraine, which since last year's so-called ceasefire has yielded countless thousands of deaths and near anarchy in the hotly disputed, geopolitically unstable Crimean Peninsula? Adding to the insanity of lies, the MSM did their best to hype today, here we go again, the emergency meeting between Vladimir Putin, Ukrainian President Poroshenko, Germany's Angela Merkel, and Francois Hollande as a potential launching pad for peace. And what a surprise, barely an hour after two mortal enemies and two European leaders with absolutely no leverage in such discussions were purported to have reached a, here we go again, agreement in principle. Frankly, the odds of Putin and Poroshenko agreeing on anything, other than cosmetically, are not much different than that of pigs flying, much less based on input from the leaders of France and Germany, who in Russia's case spent the last year attacking Putin without any real proof of wrongdoing and backing up such vitriol with vicious economic sanctions. And to think of the coincidence of such a deal being struck with 30 minutes remaining in the New York trading day, enabling yet another perfect Hail Mary rally. And this, despite the Eurogroup meeting holding the fate of Europe in the balance, plunging oil and commodity prices, and collapsing worldwide currency markets. Not to mention, as just hours earlier, Putin responded to Germany and France's top ally, America, regarding its consideration of supplying Ukraine with arms, by claiming it would be considered an act of war yielding a, quote, dramatic outcome. But heck, why let a good ceasefire story get in the way of the truth, particularly when all previous ceasefires proved to be complete and utter shams? Incredibly, the unquestionably escalating Ukrainian war, irrespective of today's ceasefire propaganda, barely ranks on today's list of potentially cataclysmic headlines. Frankly, I'm having trouble deciding whether the expanding global commodity collapse outranks the potentially Greek contagion if a bailout deal is not reached, although clearly the latter poses a more immediate risk. That said, I've spent the past 2 years warning of how exploding debt and plunging currencies are symptomatic of the terminal phase of history's largest fiat Ponzi scheme. And no event in our lifetimes, even the 2008 crisis, has caused worldwide currencies to fall as rapidly as the current, likely accelerating commodity crash, particularly as relates to oil, which unquestionably is the commodity more sovereign nations require for revenue than any other. Today alone, numerous currencies hit fresh all-time lows against the so-called strong dollar, which again I mock due to the fact that it's not rising due to economic strength, but a flight to liquidity as the final cataclysmic crash rapidly approaches. In fact, amidst the vaunted BRICS nations that were recently propagandized to be on the verge of economic dominance, the Brazilian real and South African rand hit new all-time lows, the Russian ruble is barely below its nearly hyperinflated lows, and set to plunge much further as oil prices collapse into the abyss. And the Indian rupee is making a run at its own all-time low, and this on the day when a Syriza-like populist party unexpectedly had major wins in India's key legislative elections. Not to mention the very same day that India's Ministry of Trade proposed to reduce the onerous import tariffs that have dramatically reduced India's reported gold and silver imports. In fact, if this proposal is accepted after being officially submitted on February 28th, we could see an utter frenzy of Indian gold buying, particularly at today's ridiculously suppressed levels, with the rupee on the verge of freefall to boot. In other words, the price of gold in 4 of the 5 BRICS, where more than 20% of the world's population resides, is either at, or as in the case of Russia, or near its all-time highs. And don't forget Japan, where the yen plunged to near its own multi-year low today, as well as Canada, Australia, and other first-world nations, all of whom are experiencing explosive gold and silver demand as their commodity-dependent currencies plunge into the abyss. Back to oil specifically, recall my October 15th article, Crashing Oil Prices Portend Unspeakable Horrors, when WTI crude was still $79 per barrel compared to $49 per barrel today. Not to mention my January 2nd article, The Direst Prediction of All, of how the massive overcapacity fostered by decades of money printing and financial engineering will likely yield lower prices for years to come. This was, of course, based on a lot of the fine work by David Stockman. And then consider that today's oil inventory report depicted the highest level of inventory in the 80 years since such data has been compiled. On the very same day, the Baltic Dry Index, which measures global trade activity, hit an all-time low last seen 29 years ago. Trust me, the U.S. government was behind the past week's paper goosing from $43 a barrel to a high of $54 a barrel late last week, as its algorithm footprints were as blatant as the gold cartels. And thus, the fact that it decidedly failed to hold $50 a barrel, whilst other commodities simultaneously plunged, should tell you all you need to know about what the powers that be are up against. Which is why the Fed's equally blatant effort to goose the all-important 10-year yield above 2% sticks out like a sore thumb in a worldwide market of crashing yields, aside from Greece and other pig-like nations, of course. To wit, starting with last week's utter travesty of an NFP employment report, as I discussed in Monday's Employment American Style, the Fed sought to reverse America's own plunging rate trend with abject economic lies and maniacal shorting of treasuries so as to prevent universal realization of what I last May deemed the most damning proof yet of QE failure, i.e. plunging rates despite a so-called recovery. If this understanding spreads, it will be game over for the 2-year scheme of pretending America's economy is recovering with the hope of eventually raising interest rates and enabling the Fed to reduce its toxic, heavily leveraged $4.5 trillion balance sheet. And once the world realizes rates are more likely to be taken negative than raised, the mindset of QE to infinity and hence deflation will swamp their best efforts to manipulate markets, economic data, and last but not least, gold and silver prices. Several attempts to push above 2% have already failed, as highlighted by today's explosively demanded 10-year Treasury auction. And given the massive technical resistance at this level and equally massive deflationary trends, it may be very, very difficult for the Fed to get that 2 handle to maintain. Yes, crashing commodities, a surging dollar, and exploding social and geopolitical tensions represent the powers that be's sum of all fears. And thus, all they have left are manipulations of major equity averages like the Dow Jones Propaganda Average and, against the aforementioned explosion of global physical demand, paper, gold, and silver, which is exactly what I wrote of in last week's The Last to Go. Remember, I last year deemed the aforementioned collapse of global currencies to be the single most precious metal bullish factor imaginable, and plunging oil prices that other Achilles heel. Thus, I found it not just amusing, but ironic that me, who spent 10 years as a Wall Street energy analyst praying for higher oil prices, was actively rooting for a horrifying oil inventory report, which we decidedly got, as noted above. To that end, whilst I once thought gold and silver prices would break their cartel shackles due to inflating commodity prices, I now realize that the deflation before inflation outcome is more likely, at least here in the States, as opposed to the aforementioned rest of the world, where crashing currencies are more than offsetting the modest cost of living reductions caused by falling oil prices. And speaking of deflation in the States, perhaps the most startling fact I learned today was that more than 15%, that's 1/5, of all U.S. office space currently under construction is located in Houston, Texas, home of a measly 0.5% of the total population. In other words, Texas, whose $291 billion of debt is only surpassed by that of California and New York, has the potential for an oil-related collapse never before seen in even its own infamous boom-bust history, which of course will require printing press-funded bailouts from U.S. taxpayers. Oh well, so much for Texan secession. Which brings me to today's principal topic, the tale of two commodity markets noted in today's title. The first is crude oil, whose hideous supply-demand imbalance, frankly, is shared by countless industrial commodities. As noted above, and in countless articles and podcasts in recent months, I believe oil prices may shock people to the downside, as the entire world desperately overproduces their massive overcapacity in a futile attempt to make up for plunging prices with increased volumes. No one, from the weakest junk bond finance shale producer to the lowest cost OPEC producer, will be immune from this deadly catch-22. And when all is said and done, if oil prices are 50% below today's cataclysmic levels, I wouldn't be a bit surprised. Such is the case when exploding supply meets plummeting demand, as economic Mother Nature unleashes her fury with terrifying force. Conversely, precious metals are experiencing all-time low inventories and plummeting supplies in an environment of all-time high demand, with the outlook for both such factors only accelerating in their respective opposite directions. Regarding demand, I'm not going to add more here than I have in countless other articles, as exemplified by the literally explosive Chinese imports to start 2015, accelerating demand in countless nations experiencing catastrophic currency collapses, and of course, the potential for import tariffs in India, the historically largest gold buyer, to be eliminated next month amidst an environment where the rupee is in freefall. Now I'm going to focus here on supply, following up last week's Precious Metal Mining Armageddon audioblog, in which I highlighted how this week, and particularly next, the world's largest gold and silver miners would likely report horrifying losses, reserve write-downs, and capex reductions, en route to fulfilling my year-end prediction of essentially across-the-board mining industry paralysis, and likely massive mergers which will only accelerate the rate of cost reductions and significantly decrease an already horrifying industry production profile. To that end, last night, the ugly earnings party was started by Kinross Gold, which in days of yore had such promise. But today, despite being the world's fifth largest gold producer after a 15-year bull market, has seen its stock plunge 90% from a high established 21 years ago, as its production erodes, reserves vaporize, and balance sheet disintegrates. Kinross's $900 million fourth quarter impairment charge will likely be par for the course, yielding a $1.4 billion loss for the year. Better yet, 2015 production is expected to decline 4 to 11% from 2014 levels, whilst gold reserves were written off 20% despite utilizing the same $1,200 gold price assumption as a year ago. And don't forget, last year Kinross wrote down its reserves by a whopping 35%, also with the same $1,200 price assumption as in 2012. And worse yet, part of this year's write-down was due to reclassifying a portion of last year's reserves to the lesser resources category, which comically, Kinross is not using a $1,200 price assumption for, but a way above market $1,400 per ounce. In other words, if not for utilizing ridiculous price assumptions in a classification category that's dicey to start with, total resources would likely have been written off far more dramatically. And again, all such write-downs occurred without even a modest reduction in price assumptions, demonstrating just how dicey any and all industry estimates of reserves and resources are to start with. And by the way, following such dismal results, KGC stock plunged another 8% to another all-time low. Trust me, I know, having worked 5 years in the mining industry as both an investor relations officer for specific companies and consultant to dozens of others. In those capacities, I watch projects vaporize for every imaginable reason, and rarely, if ever, receive better than expected news. Consequently, I came to the conclusion that gold and silver mining is one of the world's most challenging businesses without a price-destroying cartel, let alone when said cartel relentlessly kills mining capital for 15 years. Consequently, capital strangulation, which by the way was abetted by sociopathic Canadian investment banks' relentless naked shorting of junior mining shares, has literally vaporized whatever remaining engineering and geological talent still remained in the industry. To that end, like oil and gas, metals mining has become a young man's industry because with all the low-hanging fruit already picked, the only way to accomplish any meaningful progress is through the utilization of advanced technologies in difficult remote regions opposed by hostile indigenous populations, life-sucking environmentalists, and blood-sucking tax regimes. Care of a chronic lack of profitability, few people have studied to become mining engineers and geologists at all, let alone with experience in the aforementioned extremely challenging issues. This is why projects are consistently failing everywhere and will continue to do so for myriad reasons for the foreseeable future. And the beauty of it all is that once prices finally do break free of the cartel's deadly grip, which I assure you they will, it will be because gold and silver have become universally re-realized for their unchallenged monetary properties, at which point governments the world round will start nationalizing and windfall taxing every imaginable mining project, thus ensuring production never, ever materially increases. And this at a time when global demand will go utterly parabolic. Well, that's enough for now as it's 8:30 p.m. Eastern Standard Time. And yes, it is now official that the Greek debt deal rumor was in fact another bald-faced lie. And the ill-gotten euro gains have vaporized, and I can't wait to see the idiots that bought National Bank of Greece stock at $1.55 per share in after-hours trading get slaughtered tomorrow morning. Oh well, let's see what new desperation moves the powers that be attempt in the week's final 2 days, with the Eurogroup's February 16th Greek ultimatum looming on Monday. Not to mention, as oil prices break down, currencies crash, and the 10-year Treasury yield fights the manipulative war of its life to rise above 2%. Let alone what gold and silver prices do as physical demand rises still higher and ugly earnings reports like Kinross's flood the tape in the coming 2 weeks. To that end, we cannot emphasize just how dire the need has become to protect yourself from what's coming, as with each passing day, what's coming becomes more and more terrifying. And if you decide to act on such fears, we hope you call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email